Hello and welcome to Virtual Investor Conferences. My name is Phil Carlson, and on behalf of KCSA Strategic Communications, as well as our co-host OTC Markets Group, we're very pleased you have joined us for a fireside chat with HITI, the high-impact retail forward enterprise built to deliver real-world value across every component of cannabis. Their session will be moderated by Andrew Semple, Equity Research Analyst at Echelon Wealth Partners. Please note you could submit questions for the presenter in the box to the left of the slides. You can also view the company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Raj Grover, founder, president, and CEO of HITI, which trades on the NASDAQ under the symbol HITI and on the TSXV under the symbol HITI. Welcome, Raj and Andrew.
Great.
Thanks, Phil.
Thank you very much, Phil. Good afternoon, everyone. We really appreciate you taking the time to join us today. My name is Andrew Semple. I'm an equity research analyst here at Echelon Wealth Partners, and I've covered the cannabis industry since January 2018. Today, I have the immense pleasure to sit down with Raj Grover, founder and CEO of HITI, Canada's largest cannabis retailer. It's great to see you again, Raj, and I'm very much looking forward to our discussion here today.
Same here, Andrew. So first of all, thank you, Phil. Thank you, Andrew. It's great to be chatting with you again. And good afternoon, everyone. And thanks for tuning into our conversation. And I'm very much looking forward to our discussion here, Andrew. Let's do it.
Let's do it. So first, Raj, just to start things off, probably good to start with a bit of background about HITI, the company that you founded and brought public. Let us know a little bit about HITI as a company, and where things stand today within the business.
Great. So HITI's story began back in 2009 when I founded HITI's predecessor, Smoker's Corner, which was a small consumption accessory shop with an initial investment of $50,000 and just 2 employees. Fast forwarded to today, HITI is now Canada's largest non-franchise cannabis retailer and the second largest in North America based on store count, as we now operate 172 Canna Cabana locations across 5 Canadian provinces. In 2021, we launched the first of its kind membership-based discount club model in North America. And as per our last reported quarter, we had accumulated over 1.32 million members into our Cabana Club, which is also the largest Canadian cannabis brick and mortar loyalty program. We launched Elite, our paid membership tier, in late 2022 and have surpassed 32,000 paid members who pay us $35 annually to get even more steeper discounts and exclusive product offerings. We also strategically diversified our retail ecosystem, which also includes 3 of the top 5 consumption accessory e-commerce platforms in the world, as well as 3 of the top tier international hemp-derived online CBD brands in the US and the UK. And Andrew, while HITI has seen tremendous growth over the past 6 years, growing from just $8 million in revenue to over $500 million in annual revenue run rate, we have also reported positive adjusted EBITDA for 16 straight quarters now, and have now reported 3 consecutive quarters of positive free cash flow generation, which is, again, as you know, a rarity in the Canadian cannabis sector.
Wow. I mean, that's just remarkable, hearing that 8 million of sales to $500 million. That's an incredible achievement. And that's despite retail having actually been a fairly tough industry within cannabis. We've already seen several, if not most, actually, of the largest publicly traded Canadian cannabis retailers enter creditor protection. Some examples there include Fire & Flower, Choom, Chiaro, Shiny Bud. You have approached the Canadian retail market with a very different retail strategy, which is, as you alluded to, in what you call the discount club model. Could you tell us a little bit more about the discount club model, why this strategy has worked, why this has resonated with consumers, and provide us a little bit of an update on how the latest iteration of this, Cabana Elite, how that membership program is going?
Sure. So look, there's absolutely no doubt that it's been a tough going for most cannabis companies both on the retail and the production side here in Canada. And many of our publicly traded retail peers have filed for bankruptcy protection, including some of the larger names, like you mentioned, Fire and Flower. And a similar announcement came out of Alberta just a couple of days ago. 420 is now filing for bankruptcy protection here in Alberta, which I believe had 35 or 40 retail stores. So, where we differentiate from our peers is our unique retail model, our superior understanding of our business and the industry in which we operate. It's a very different industry and a very new industry, and of course our operational execution. So, look, we've also had all the data that's been available to us for quite some time now. We've known that over 70% of Canadian cannabis customers care strictly about price. Knowing this, and by leveraging the full strengths of our diversified retail ecosystem, we are able to provide our members with the lowest price guarantee on high quality cannabis, consumption accessory, and CBD products, while showcasing a massive variety or a very large inventory selection in the country, which is second to none, which also helps draw and retain our club members. So, we also strategically, if you remember in 2021, we made 6 e-commerce acquisitions. We strategically did that. We strategically acquired high margin ancillary cannabis businesses internationally to build our aggressive discount club model here in Canada. And that's paying dividends today. So thanks to our differentiated retail strategy and our unique discount club model, we now have roughly 12 to 14% of overall cannabis consumers in the provinces where we operate as part of our Cabana Club. And then I think your second part, your question regarding Elite, over the past 2 quarters, I couldn't be more happier with the progress of Elite. Over the past 2 quarters, our Elite membership has grown at its fastest pace since inception, increasing, I believe, 237% year over year. And we now have 32,000 paid members who pay us $35 a year, which is actually up from $30 a year. And fortunately for us, this paid membership base is continuing to expand at a rapid rate.
Great, great. And just to be clear on how the membership program works, right, for all the viewers here, it's free to be a Cabana Club member. And what's happening now is you're beginning to shift these initial Cabana Club members into paid for Elite membership. And so you're going to see a lot of high margin growth opportunity from that. Is that right?
Absolutely, and that was our promise when we, or our vision that we put out when we launched the discount club model, that initially memberships are free, but eventually this will turn into a paid membership program, similar to some of the other very successful wholesaler retailers that we know about. So that was absolutely the plan, and we very much were able to execute on this. We launched Elite in November of 2022. And since then, every single quarter we've been beating the pace of the previous quarter, and things haven't changed, Andrew. We are very much on the progress remains exactly the same.
Great. And you spoke to 12 to 14% of the Canadian consumer base being Elite members. And I believe in their latest earnings release, you spoke to within the 5 provinces where you operate retail stores today, High Tide has surpassed over 10% retail market share. And I believe that stood closer to 3% before you launched your discount club model. So clearly that's come a long ways forward. Do you still see opportunity for retail market share growth and market share gains in the Canadian market? Or is your growth opportunities begin to turn to more international markets in upcoming countries with legislative reform?
No, we absolutely see a ton of growth opportunities here in Canada, as our long-term goal, Andrew, as you know, is to reach 300 Canna Cabanas, put up 300 cabanas operating across the country. So we have a lot of room to grow. Our initial goal was to reach 10% market share, as you may recall, in Canada, and we got there in Q4 of last year. Our new goal has been to reach 15% market share in Canada, and we are steadily heading towards that new goal now. And as you're aware, Andrew, we took a strategic pause on growth to focus on free cash flow generation, which was very much needed given the uncertainty in the cannabis capital markets. So, we achieved that goal in flying colors and 5 months ahead of our communicated timeline to the market. Over the past 5 months, we've upped the ante again on growth, and we've opened 10 additional stores starting this year in January, all organically since the beginning of this year. And we have many more in the pipeline to meet our communicated goal of adding another 20 to 30 locations by the end of this calendar year, which we are very much on track to achieve. And this should help us gain even more market share in the coming months for sure. I'm quite confident we will be able to do that. And especially with all of these disruptions that are going on, Andrew, in the market, many of our competitors filing for CCAA protection, a lot of these revenue dollars are going to disproportionately come back to High Tide given our size and scale. And the one other big factor that I want to point out is that our stores are a lot more productive than our peers. As an average, as our average store is generating approximately $2.7 million a year in comparison to just $1.2 million, which is our peer average in the provinces where we operate. And then if you look at Ontario, which is Canada's largest market, our average store generates $3.5 million a year versus our peer average of only $1.2 million again. So, we have amassed over 10% retail market share in dollars while only representing 4.7% of the country's brick and mortar store count.
Wow. And with those, stores that have outperformed in a very competitive environment again in Canada, maybe just as a follow up there, as you look to international opportunities, potentially in Europe or the US, what excites you internationally and outside the borders of Canada? And how are you thinking about some of these international markets as it relates to High Tide?
So look, Canada alone, we are at 172. We're growing very rapidly. We still got a nice runway to 300 stores. Our brick and mortar portfolio generates approximately 460 million Canadian dollars here annually. We think we can take this to, close to $900 million in Canada alone in the long term, which is massive. So, I'm not on a horse to run after international opportunities, but it's no secret that we've made our intentions very clear that we want to bring our winning discount model to Germany and then the United States once regulations allow us to do so. Germany recently legalized cannabis, as you know, and is now working on introducing Pillar 2 of the legislation, which will allow specialty cannabis stores, which is very similar here in Canada, in certain pilot regions. And our team is monitoring these developments out of Germany very closely. And of course, our intention is to participate in this Pillar 2 pilot program as soon as we can assess regulatory developments which will be favorable to this Pillar 2 pilot program. But we've made our intentions very clear. We want to be in Germany, and we are very much aligned and very much focused on what's coming out of Germany in terms of regulatory developments. And then on the US front, we are seeing good momentum with the recent rescheduling news. We trade on the NASDAQ stock exchange, which currently does not allow any plant touching business in the United States. However, this can change with some safe harbor language that's accompanied in the Attorney General memo or through further cannabis reforms such as a descheduling event or full federal legalization in the United States. Our long-term goal is to become a top 5 multi-state operator in the United States, and we are surely going to pursue the U.S. opportunity in the future when allowed.
Great. And looking forward to those regulatory changes to come as well. Maybe just turning back to Canada for a little bit, we saw, just last week that Canada's GDP underperformed expectations, and there's some pretty significant pressure there on consumer spending, continues to remain pretty soft in Canada, and perhaps more specifically to cannabis sales. As we look at Statistics Canada data, Hi-Fire data, that seems to imply that for the past 3 months, sales there have been about 8% lower than the prior quarter. How is High Tide faring in a tougher environment, for a tougher economic environment? And what are you doing to retain your customers and your profitability in this tougher spending environment?
So look, you're absolutely right. You can see it in our data on a macro level. Things have really slowed down considerably this calendar year, right? Like all this data is coming out. We're looking at the same numbers that you're looking at, that overall sales have slowed down. It's down 8%. But ultimately, Andrew, we are also a product of our environment, and we can't be totally immune to what's happening on an industry-wide slowdown. If it's an industry-wide slowdown, we're part of it. But that said, we obsess every month over the data that comes out, comparing our performance versus the industry. And we want to be absolutely sure that we are still trending and still outperforming our peers and the overall market. And I can tell you, nothing has changed on that front. But I will remind our listeners that we are a product of our environment. However, I'm extremely happy to see where we stand in terms of our performance versus the market. And then, we continue to retain customers with our attractive and innovative, unique discount club model and our superior real estate strategy that I've spoken about multiple times. We're very focused on this anchored real estate strategy where we are locating our stores next to Walmart, and LCBO in Ontario and Home Depot and a lot of these bigger, larger brick and mortar retailers. And that's really beneficial to what we are doing here. When you have a superb model, when you have a very powerful and potent model, and you can go back to the original mantra of retail, which is location, location, location. It gets very hard for someone to beat you. So we're very focused on that. And in a period like this where top line growth has definitely slowed, we have made it a point to make sure that we take whatever cost we can out of the system so we can maintain our focus on bottom line and consistent and strong free cash flow generation.
Great. I mean, we've seen High Tide navigate tough times before. I recall early on, shortly after launching coverage, we saw a cash balance for High Tide that was low as $1 million. So, Raj, I know you've been in the trenches before. Fortunately, today, and as we're looking at how High Tide stands today, you're sitting on a war chest of nearly $29 million of cash in the last quarter that you reported. And you've managed to accumulate this cash well, as you mentioned, accelerating store developments, making some debt repayments, investing in net working capital, et cetera. With the larger cash balance today, what are your plans moving forward for deploying capital within the business?
You're taking me to way back playback. The saying, what doesn't kill you makes you stronger. And that's absolutely true in our case, Andrew. So it was October of 2019, to be precise, when we hit rock bottom on our cash position, as the industry had taken a drastic downturn here in Canada. And, capital raises were virtually non-existent for smaller cannabis companies at the time. But fortunately for us, we were able to make the right strategic moves, which we've been doing consistently, and navigate through these very difficult and challenging times, or that challenging time historically. I see that as a blessing in disguise today because we learned some very valuable lessons. And since then, we have been consistently fortifying our cash position. We made the strategic decision just a little over a year ago to become amongst the first few Canadian cannabis companies to be free cash flow positive. And we have been demonstrating that over the last several quarters, producing consistent and strong free cash flows, running at approximately $18 million a year while growing and while paying down our debt, which is a beautiful sequence to have. And accordingly, Andrew, we have sufficient internal cash flow to keep growing our store count through our own funds. And that said, as I mentioned in our last earnings call, we are working to get even more debt right now because we are severely underlevered. We are at less than 1 times gross debt to adjusted EBITDA. So, we got a lot of room there, but we consistently make free cash flow. So we are in a really good position right now.
Great. And then as it turns in terms of investment opportunities for High Tide, historically High Tide has been very active with M&A. You completed the landmark acquisition of Meta Growth in 2020, and you've done dozens of retail acquisitions since then. However, we've seen a bit of a slowdown in 2023 and so far in 2024. As the business has been laser focused on getting to that positive free cash flow figure. Now that you stand there, how are you thinking about M&A today? Do you think that we'll see an acceleration again in High Tide looking at M&A and conducting M&A in the retail cannabis space in Canada?
Yeah, look, absolutely, Andrew. As you may be aware, we have been one of the most active consolidators in the retail cannabis space here in Canada. But we've always been very aware and present about the innings that we've been playing in or we play in. And we've always known on when to accelerate on growth and when to take our foot off the gas pedal. So we put a pause on M&A in 2023 as we were completely focused on generating free cash flow. Now that we have proven that we can generate FCF from our existing store base, we are going to start re-accelerating our M&A trajectory as well this year. And we are actually currently in discussions with operators of various sizes, single stores, double units, and even some of the larger blocks. But that said, Andrew, and I've said this before, many times, that the vast majority of what we are seeing in terms of opportunities simply aren't worth buying. I mean, look at what's happening all around us. A lot of the independent players, a lot of the small regional chains, a lot of the publicly traded peers. I mean, I can count 6 or 7 publicly traded companies now calling it a day and filing for bankruptcy protection. So there's really not many opportunities where there's a lot of good assets to buy, and this is either due to inferior real estate, or their weak financials, or just too much competition versus population, right? And some of these sellers have really unrealistic expectations on multiples, given that this has been a buyer's market and it is clearly a buyer's market. We're patient, right? We're growing at a very rapid rate. We added 10 stores organically this year alone. This is the best type of growth you can get into any business. I spent, roughly $300,000 to build a store, and then another $100,000 in working capital, and we are well on our way. In 6 months, we're hitting payback levels for these stores. So we're looking really, really good in that sense. So we're not in a horse to make foolish decisions on M&A. However, now the tide is turning a little bit because we see consolidation galore in the Canadian cannabis landscape again. And remember, our mandate has always been to buy good companies at an attractive multiple and make them better, not the other way around. Buy broken businesses, buy turnaround stories. Who has the time for that? We are now smooth sailing with our model here in Canada, and we don't want to do anything out of the ordinary to disrupt the momentum that we have just for the sake of doing M&A. But I'll end on these last 2 words, okay? Stay tuned.
Great. Well, looking forward to future M&A to come, but and maybe just as a bit of a follow-up to that one, I'm guessing with the success and the productivity you're seeing of your existing stores, there's also less pressure probably on the business to do M&A. When you're confident that when you build a store next to your competitors and it can be twice the level of productivity or sales per store than a provincial average, that doesn't mean that you're in any way pressured or feel the need to do M&A anymore, given you've got this organic growth opportunity as well. Correct? Is that another evolution of the M&A strategy?
You're absolutely correct, Andrew. Your analysis is always spot on. I'll tell you this. Look, we have 172 stores in the country. We built roughly 65% through organic growth. Organic growth is the best growth any company can have. We get red carpet welcome from some of the largest landlords in the country. We've got great relationships with them. I can enter saturated areas in Canada. I like to give example of this one market in Alberta, Sherwood Park, Alberta, where it's the most saturated cannabis market in the country in terms of the population and the number of stores. And we were patient to enter this market, and then we acquired some of the best real estate in that market. And now our stores ramped up to an above average Alberta store, and it's the most saturated market in Canada. So we will continue to go into saturated markets as long as we have the best location to do so organically, and we continue to get these locations. And to your point, this is exactly the reason why we've not worried too much about just doing M&A for the sake of it, because we need to catch up with somebody. Others potentially need to catch up with us. We're not in that position. We're already ahead. We're already also generating consistent free cash flows while growing so strongly. So all we got to do now is not mess up a great thing that we have going. However, we have great ambitions. We want to be the largest in this country. We want to be one of the largest cannabis retail operators globally. And to do so, you can't do it all organically. I'll get more gray hair if we waited for that. But so there will be a lot of M&A, but we're going to do high quality M&A. We're not going to do it just for the sake of doing it.
Great. And probably the last question from me, just given the time, would be on regulatory catalysts up and coming for Canadian cannabis retailers. I think we saw just earlier this week or late last week, Alberta approved white label cannabis sales. We saw the movement on Ontario to double the retail store cap. what regulatory opportunities do you continue to see in the Canadian market, and how does High Tide participate as red tape continues to ease across the country?
So look, like we've been experiencing great regulatory tailwinds for cannabis pretty much across all the provinces where we operate, and especially in Ontario and Alberta, which are the larger cannabis markets here in Canada. Our GR team is one of the most active GR teams in the country. We're constantly in touch with the regulators across the country, where we are actively lobbying across provinces, and we are starting to yield great results from it. And our competitors can also thank us for our efforts, for what we are doing across Canada. But, for example, Alberta just allowed white label. That just happened a couple days ago. We put out a press release yesterday confirming that. And this is fantastic news, given we are the largest retailer here in the province with 79 operational locations and more coming. Talking about Manitoba, as you know, I think last year, Manitoba eliminated the SRF fee, the social responsibility fee that was the retailers had to pay for the last few years. And they've also put a pause on controlled access licenses, protecting youth and preserving the existing cannabis retail landscape. And the big one of all, which was the Ontario's cap increase, which we had to work very hard for, showing the case studies to the government of Ontario. It took us a year to do it, which was also probably the biggest of all, as we added we can now go from 75 to 150 stores, and that added $250 million in revenue opportunity alone. Conservatively speaking, if our stores don't do $3.5 million in the future and just do $3 million, it's still north of $225 million, that additional opportunity that we get, right? So, and that's going to have a big impact on our bottom line. It's going to have a big impact on legal cannabis landscape. When this news was delivered, at that time, the government was very aware that illicit rates in Ontario are sitting at 45%, which is amongst the highest in the country. And it was not a hard decision for the government of Ontario to help the legal cannabis sector versus illicit market products, that youth could have potential access to. So that's happened. There's a lot of good things going on. We're also hearing and we have some knowledge about Ontario and Alberta working on rolling out additional legislative and regulatory measures to crack down on the illicit market. So there's more coming on that front. They're allocating more dollars towards it. And then the last province, BC, unfortunately, everything is on hold until the election in BC. It was considering an increase in store cap and also, I believe, possible pop-ups at trade shows and festivals. And also white label for retailers. But we know that this is on hold for now, so we'll have to see how these things pan out in the future.
Great. And then definitely want to make sure we address some of the audience questions here. And just given the time, 2 minutes, maybe go through these quickly. First of all, what would be some of the elite membership benefit? What would be some of the benefits for elite members versus your regular Cabana Club members? What would some of those be to entice people to pay for their subscription model?
Yeah, so we have some very attractive benefits in Elite. We have the Elite weekly drops. Every single week, we drop an accessory to prices that I myself find hard to believe, but I enjoy them very much when I see them. And that weekly drop alone can pay for your Elite membership for the year, sometimes 3 to 5 years, believe it or not. So look it up. You'll enjoy looking at that. It's called Elite Weekly Drops. We have even more steeper discounts for our Elite members in the range of 5 to 7% additional discounts than the regular Cabana Club. So it's hard to say no to Elite. This is why we're ramping up so quickly. We also have exclusive product selection available to Elite members. We also offer free delivery where applicable and where available. And of course, many other perks that are quite attractive.
Great. And then another question here on retail store productivity might alter this one a little bit. As your retail strategy evolves, as you spend more and more time doing this, do you think that your stores have an opportunity to get more productive, your newer stores to get more productive than some of the existing stores, or how do you see that playing out?
So look, newer stores are going to take time to ramp up, Andrew. We are in a heavily saturated landscape, but we're going to get our fair share. We're going to build our 300 store portfolio. and we want to reach that target sooner rather than later. But these stores are not ramping up as quickly as our original stores, simply because now there's just like 8 competitors surrounding us. We will outlast these competitors given our very strong model and given our high quality location selection criteria that we have. But these stores are taking longer to ramp up. So to get a new Ontario store to $3.5 million, it'll happen in due course, but it will take time to go there. And I would like to remind the listeners here that, initially, when you're building these stores and you're putting out these stores, unless you're buying a store, there's this ramp up period where you're burning EBITDA and you're burning cash flow. But eventually, you go into positive territory and start growing from there. So if I'm taking a long-term view of this, we're absolutely going to continue to get more and more productive. And you can see that in our same-store sales growth. Our same-store sales are up 103% over the last 9 quarters. And any retailer should be gauged through their same-store sales growth. And we are winning on that front. So that gives me confidence that our stores will continue to get more and more productive, but we also have to wait for competition to decline to make that happen.
That's great. And I see we're probably a bit over time here, so we're going to wrap things up. First of all, I just want to thank everyone who came and joined us today for this presentation. Raj, I want to thank you for taking the time with us today as well. I could have spoken with you for another half an hour or a full hour. It's always a pleasure. So glad to hear things are going well in the business. And thank you very much to KCSA and the OTC team, for setting this up. So thank you all.
Yeah, thanks so much, Andrew. Really enjoyed our conversation, and thank you.